Well, it's been done before. It was done, I think, one summer ago, and it didn't last very long, but it does have huge implications, especially if it's prolonged, meaning that they cut off personal credit lines. Personal credit lines are what we used to call signature loans. It's based on your credit score in most cases. So you're able to write a check anywhere from 3,000 to 100,000 on your basically good credit. Now that's being taken away. I think they've got 60 days to close out whatever they've got and continue to make their payment, the minimum payment. That's the way I read it on Zero Hedge. But this is a contraction in the credit system, which is how the whole economy is based. I mean, everything is based on, buy now, pay later type of thing. And in a lot of cases, that makes a lot of sense. The use of capital for a productive project or a mortgage or expansion or whatever certainly is the way the system works. I'm not against that at all. But when you have a sharp decrease and a contraction like this, it's going to spill over not only into, let's say, personal people, but also businesses, because some of these larger credit lines could be used as like a bridge loan. In other words, you're waiting for your payment from China, and it's a net 90. It's a 90-day invoice. So you've got that credit line to make it up until you get paid. Or in the case of maybe a rental property, you've got a pretty large ability to, again, bridge the gap before you get that payment, or you maybe have to make that once a year insurance payment to the insurance company for your apartment complex, whatever. So this will put the hurt on people. I don't want to exaggerate. I'm trying to paint a clear picture, but it's something that you do want to pay attention to. And to repeat what you said, it is, I think, the start of probably some type of deflationary forces that we're going to witness in the U.S. economy. Something I've been fascinated with since I was a young kid. And, money makes the world go round. Really, it's energy, but I won't talk about that. And the whole system has been, on weak legs, I would say, from the 2008 crisis. Yes, I know we're many years beyond that, but we really haven't fixed the core issues. And that's really too much credit in the system. Or let's say credit that doesn't have really good use. A lot of it's just sitting on balance sheets in the banking sector. So now they're contracting where a lot of that credit is put to good use. And so again, I think this is going to have bigger consequences perhaps than we think.
Do you think we'll see other banks follow suit here? Would you be surprised?
I'm really open on that. I don't know. I think it could. I think what will be interesting to see what people do when they make their minimum payments on a credit line and they know it's going to be stopped. And the example of, let's say, a real estate person might go to a different institution and try to establish a credit line there. It's hard to say what will happen, but it's definitely something I'm watching closely. Well, I adhere to the Austrian school pretty much. And, by definition, an increase in the money supply is inflation. So you inflated the money supply. However, when it's sitting on the balance sheets of banks and really isn't put into the physical economy, it really doesn't have a lot of meaning. And that's the case we've had for quite a long time. This is the real economy. And therefore, if you have less money in circulation, or you have to, let's say, forego a purchase that you're going to make that might expand the economy, but you can't because now your credit line is coming to an end. It's a contraction. So when you have less money, that's deflationary. It's really that simple. It's deflationary. You would see probably some asset prices come down. You'd also see things like food that's a necessity continue up. That's a whole different dynamic. It's not based so much on the money supply. It's based on its supply. Yeah, it's been in a trading range. We're at the bottom of the range for silver right now. Gold's got above 1,800 USD, which is important. But silver's at an inflection point. It needs to show some strength here. If it doesn't, we're probably going to see lower prices, unfortunately, for silver longs. On the other hand, I'm not worried long term. Summers are usually the doldrums. I mean, in the past, it was pretty easy to forecast that summers would be bad for the metals because of the European traders usually took these very long vacations. There's just less trading activity. Of course, with the illness, that's really not the case anymore. So we could see, a 2016 repeat where we had a very strong summer and it went all the way into September. I don't see that. I think it's more likely to trade in this range, maybe work its way higher and possibly lower. The key place really is the $26 level as a round number. If we breach that to the downside and stay there for a few days in a row, and especially if the volume is large, I would expect that continuing for a few more months. Again, my forecast for the end of the year hasn't changed much. I said it could get to 40. Will it? It may. It's going to really depend on these dynamic changes that we're talking about, Daniela, because there's this, what I call this bending of the paperclip, up, down, inflation, deflation, inflation, deflation, inflation. Sooner or later, it breaks.
And when it breaks,
then we have some real problems. That's when you have, banking holiday as an extreme example. You get so much money put in the system, it goes from a deflationary mindset to a hyperinflationary mindset. I mean, things that are on the edge, as we're talking about, once you go over that edge, you're in the unknown. I mean, people are taught to believe that, and there's a lot of commentary about that, but real interest rates are what matter. And we have no real interest rates that are of substance whatsoever at all. I mean, if you look at the true inflation rate, it's around 9%. So we'd have to be above that to get a real rate of return. The bond market, in my view, will never get there this time.
Right.
The fundamentals are stronger than ever. The price just isn't reflecting those fundamentals. And these markets can, wear you out. But it's longer term, very, very bullish. My premise is that a large part of the move comes in the last part of the time. So my projection is we're going to get much higher prices in the next 2 to 3 years. However, you could build a case that it'll be another decade. I mean, if you go to the USGS, United States Geological Survey, they will tell you in writing that the first element to go off the periodic chart is silver. What does that mean? What they meant was it's going to be so scarce that it's really going to be more or less unavailable. Now, we all know that's ridiculous, and it's a variable. It depends on the price of silver. What's unavailable at $20 an ounce or $30 an ounce is totally available at $150 an ounce. So there is a variability to it. The point being is that of all the elements in the earth, silver is probably the least available over the next decade. Least available as far as amount there and amount used. Silver market is the bullion market. So if you really want to think about it correctly, there's the silver bullion market, the silver industrial market, and the silver investment market. There's really 3 areas, and you could even break it down further with silverware or jewelry, but I won't. So the bullion market, which sets the price, is commercial bars. And those commercial bars, for the most part, are either held for investment purposes or industry. Most of it goes to industry, over 50%. So the retail price doesn't reflect the silver price. It reflects the cost of a 100-ounce bar, a government minted coin, or that type of thing. And there's always a premium because it costs money, energy, time, and labor to turn a 1,000-ounce bar into 1,001-ounce silver maples, right? So people get a little confused on why, it costs more. Some do. Anyone that really acquainted with the market doesn't understand that. So the price is determined in the derivatives market. And the derivatives market is basically unlimited buy and sell orders on paper. Yes, there's silver in the warehouses to back it up. There's only like a small amount relative to the amount of trading that's done. So as long as the paper paradigm holds, and every once in a while when some silver is taken off the exchange to meet the demand of the physical contract being executed, the game can be priced almost anywhere. So when we had this big thing about the Fed announcement being hawkish and silver got creamed, that was just timing. It was a mere coincidence because that amount of paper selling would have taken the price down any day of the week or any month of the year. There's no doubt in my mind. We have so much empirical evidence for that. It would be standing up in court anywhere in the world as long as they were honest. The thing that bears repeating now is they would say that you cannot manipulate the long-term trend. So if you look at gold from the bottom of 2000 or $252 an ounce to today's 1800, I think you'd have to admit that gold's gone up, and that's the main trend for gold. Silver, the same thing. However, within that main trend, you certainly can manage the price time and time and time again, and that's obvious. In the book, The Silver Manifesto, I wrote with Chris Marchese, we do a whole chapter. We build the chapter on manipulation, building up on fractional reserve banking, fractional reserve bullion banking, And then we go to the manipulation. We show the spread between the London Open and the New York Open. It's absolutely impossible for that to be a random walk. And then on top of that, we use the Sharpe's ratio, which is a determination of the probability of something taking place. And it proves mathematically that it is manipulated. So I'll say managed at certain times. So there's a reason for it, and that I don't want to get into. It gets into why it gets through intent, and that would mean I'd have to interview everybody on the planet of why did you sell, or why did you sell in the paper? But Daniela, you're right. I mean, look, there's been many instances in the main press of manipulation, and call it spoofing. You can call it any name you want. And yet it gets a big yawn, meaning that rather than, put somebody in jail, or what I would do, but it's not up to me, is I would ban that facility, in other words, that bullion bank as an example, from trading in that commodity for 6 months, teach them a lesson, so to speak. Don't ban them forever, but no, that's not what happens. They pay a fine, and the fine is minuscule compared to the amount of money that are made by running the stops or taking advantage of the longs. Really not talked enough about energy. I'm no expert. I did an energy letter for a year and failed, but I really do like the energy sector. I particularly like the oil markets, but I look at the alternative energy sector as well. In fact, I did a video on green energy and the implications. It should be out on my website fairly soon.